This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the U.S. jobs report for October and November and what the combined data suggests about the current trajectory of the U.S. labor market, inflation dynamics, and the immediate future for interest rate policy. We're diving deep into the latest numbers, and the main theme seems pretty clear.
It is. The labor market is flashing some serious warning signs that, the official narrative might be a little slow to acknowledge.
And that structural weakness is really the key takeaway here, isn't it?
It really is. This simultaneous release for 2 months gives us a critical snapshot. And what we're seeing is a definite, and I'd say accelerating, move towards softness in the market.
So we're talking about significant job losses, a jump in unemployment, and some pretty concerning layoff figures.
Exactly. And this is all happening while the Fed is already cutting interest rates to try and support the economy. The time for wondering if the market is weakening is over.
Right. Now the focus is on how fast and why it's declining. So let's start with those raw numbers. We got data for both October and November. What stands out when you look at them together?
Well, October was a shock. Our sources are calling it a brutally bad month. The U.S. labor market lost a massive 105,000 jobs.
Over 100,000 jobs gone. That's the kind of figure that really gets your attention.
It is. And then November comes along with a gain of 64,000 jobs.
So a big loss, then a small gain. On a net basis over 2 months, that's still a loss. But I think the real story is a bigger trend, right? Not just these two data points.
The trend is the signal, absolutely. The slowdown has been visible for a couple of years, but it's gotten really sharp in just the last 6 months.
And we've now had job losses in 3 of those 6 months.
Exactly. So October wasn't some random fluke. It was the sharpest point in an accelerating downturn. For anyone watching the markets, this pattern screams weakness.
This brings us to a really crucial point, which is the accuracy of the data itself. There's a lot of skepticism around these government-reported figures.
A huge amount. And it's not just market chatter. The consensus among many analysts is that these figures are probably overstated and will likely be revised down later.
And the skepticism goes right to the top, doesn't it? We noted comments from the Federal Reserve Chair himself.
That's right. He recently suggested that the job numbers could be overstated by as much as 60,000 jobs every single month.
60,000 a month. That's a staggering number. If he's right, it means the labor market has been much weaker than the reports have shown for a while now.
It's a huge indictment of the reporting. And it's why the market is so focused on other things like layoff announcements and company earnings to get a true picture of what's happening.
So let's turn to the one indicator the Fed chair said was the single most important data point, the unemployment rate.
Today's report showed that rate jumping to 4.6%. That is a significant move up.
And that's so critical because it's a broader measure than just the monthly job creation number. A sustained rise like this really justifies the Fed's easing bias.
It does, but you could even argue that 4.6% might still understate the problem.
How so? Because of discouraged workers.
Precisely. It doesn't fully account for people who've just stopped looking for work or those stuck in part-time jobs when they really want full-time. So while the official jump signals pain, the reality on the ground is likely even softer.
Okay, let's transition to what this means for people's wallets. The pay cut reality. We saw that wages are growing at about 3.5%.
And that 3.5% collides head-on with inflation. Based on our analysis, the effective rate of inflation, the one that's really eating away at your purchasing power, is running around 6%.
So the math is simple. Most people are seeing their real pay go down.
They're going backwards. Their paychecks aren't keeping up.
Now, let's pause on that 6% figure, because a lot of people will hear that and say, wait, the official CPI number is only 3.0%. Why the difference?
That's a critical distinction. The CPI measures the change in the cost of a really broad basket of things, the government's definition of the cost of living. But our sources argue that for the average family, the real pain is in the price of necessities, things like food, energy, housing. And those essentials are rising much closer to that 6% rate.
So the 3.0% CPI number gets skewed by things like, say, the price of television's falling, which masks the fact that your grocery bill is still soaring.
You've got it. That's why the 6% figure is what truly defines the erosion of purchasing power for most households.
So if you're thinking about your finances, you technically need a 6% raise just to stay where you are.
That's the baseline, just to tread water. And that pressure on households and businesses. Well, that leads us directly to the topic of mass layoffs.
This is where the corporate actions really tell the story. The latest Challenger report is just staggering. Job cuts are up 54% year over year.
54%, that's a dramatic reversal. The total number of announced cuts from January to November was over 1.17 million people.
And when you look at why companies are making these cuts, it seems to be shifting from just a cyclical slowdown to something more permanent.
I think so. Restructuring and store closings made up a huge chunk of the losses in November. We're talking about over 237,000 jobs combined. Those are permanent shifts, not temporary freezes.
And the number that really jumped out at me was the role of AI.
Yes, artificial intelligence was cited for over 6,200 job cuts in November alone.
And that's part of a bigger trend this year. Nearly 55,000 cuts attributed to AI so far.
Right, and those jobs aren't cyclical. They're permanent displacements. This is a long-term change in the labor market. Companies aren't just adjusting to lower demand. They're fundamentally replacing human labor with technology.
So the jobs being lost now might not come back, even when the economy recovers.
That's the concern. The bar will be much higher for the skills needed in the future.
If we look at the industries cutting the most, they seem to fall into two big buckets. Businesses getting squeezed by costs and businesses hit by slowing demand.
That's a great way to group them. On the squeeze side, you have nonprofits losing government funding and food companies dealing with rising input costs. They're reacting to outside financial pressure.
And on the softening demand side, we saw big cuts in retail. This is the data that really pushes back on that narrative of the strong, resilient consumer.
It does. Retailers' actions suggest demand is falling. We also saw it in the services sector staffing, cleaning firms. That's a classic sign businesses are pulling back because they see a downturn coming.
And then there are the tech companies still doing their right sizing.
Yes, right sizing. The corporate vocabulary for downsizing, a sure sign of a slowdown. They're still correcting for all the overhiring they did during the pandemic.
And the hardest hit industry in November was telecommunications.
Yes, the cuts there were all about immediate cost savings. That's a defensive move you make when you're worried about future revenue.
All of this, the weak jobs data, the unemployment jump, the layoffs, it's the exact rationale the Fed would use to justify its policy.
It is. We know the Fed has already been cutting interest rates to try and stabilize this exact situation. But their problem is complicated by the money supply.
Which is already at an all-time record high. And we saw it's been growing recently at about a 5% annualized rate.
That massive amount of cash in the system is working against their efforts to control long-term inflation. And what's concerning is that our sources say the money printers were turned back on last Friday.
Meaning more liquidity injections.
Right, so you combine that with the recent rate cuts, and we could see money supply growth get closer to 6%. That just adds more inflationary fuel to the fire.
So how did the market react to this jobs report? The next Fed meeting is January 28th. What happened to the odds of a rate cut?
This is what's fascinating. Before the report, the odds of a cut were 24.4%.
And after?
Unchanged. Still exactly 24.4%.
So the market just shrugged it off.
It seems so. Either the weakness was already completely priced in, or, what I think is more likely, the market is just so focused on the next piece of data, the inflation report, that this jobs number didn't really move the needle for the January decision.
Let's look further out then. The Fed's own long-term forecast, the summary of economic projections. What does it say?
Well, the current SAP is surprisingly conservative. It's only projecting one single quarter-point interest rate cut in all of 2026.
That seems completely out of sync with the weakness we're discussing.
It does. It feels unrealistic if the labor market keeps getting worse at this pace.
But there's a big political factor here, which is the change in leadership at the Fed. A new chair takes over in May 2026.
And that's the key variable. It's very likely a new Fed chair facing this kind of economy would be much more aggressive with rate cuts than the current forecast suggests. The market might be betting on that change more than on the current projections.
Okay, that brings us to our final section, key investor considerations. With weak jobs, structural layoffs, and high money supply, what should you be focusing on?
In the short term, the story is that this weak labor market gives the Fed a continued reason to have an easing bias. That just means they're ready and willing to cut rates, regardless of what that 2026 forecast says.
And the long-term implication.
It's all about your purchasing power. The high growth in money supply, paired with wage growth that's stuck at 3.5%, means a continued structural erosion of your buying power.
That trend only reverses if wages start growing significantly faster than that 6% effective inflation rate.
A scenario that seems less and less likely, especially with AI taking on a bigger role in the job market.
So to wrap up, The jobs report gives us the backdrop. What's the next big signal we should all be watching for?
That would be the inflation report. It comes out this Thursday, just 2 days from now. That will be the next major piece of the puzzle for the market and for the Fed.
Perfect. Let's summarize the essential takeaways from this deep dive.
First, the U.S. labor market showed critical weakness, continuing a 6-month downward trend. The unemployment rate jumped to 4.6%, and we noted the official job numbers are likely overstated.
Second, layoffs are up a massive 54% year over year. And these cuts are driven by permanent structural changes, including nearly 55,000 jobs lost specifically to artificial intelligence this year.
Third, the effective inflation rate is around 6%, which means that the average 3.5% wage growth is actually a real pay cut for most American households, and it's squeezing their purchasing power.
Fourth, the money supply is growing at a 5 to 6% annualized rate, which makes it much harder for the Fed to fight inflation, even as they cut rates to support the weak job market.
And finally, while the odds of a January rate cut are low, the Fed's official forecast of only one cut in all of 2026 is likely too conservative. A new Fed chair in May 2026 could bring much more aggressive action.
Thanks for listening to the 15-Minute Investor.